Hey everyone, Cameron Lombardi back here with another stock market investing video. Today we're going to be talking about trading with margin and using it to leverage your portfolio. Before we get into that, if you all wouldn't mind hitting that like button just below the video, it really helps the video reach more people and the channel grow. If you like these videos, definitely subscribe and follow along to see how selling options can grow your account over time. And if you'd like to get started on your investing journey, use the first link in the description to sign up for a free Robinhood account. And by using that link, you'll get yourself a free stock to get started. All right, everyone. So today we're going to be talking about margin in your investment account and the risks and rewards of using it. Please note that this is simply an opinion and is not meant to be taken as financial advice. I'm going to show how I plan on using margin to leverage my account and earn passive income. But first, let's discuss what margin is and the risks and rewards of using it. Margin is a way to borrow money from your brokerage to buy more shares of stock or mutual funds. This can be a great way to increase your profits, but it also comes with some risks. Now, Robinhood allows you to use margin, but you are going to be charged an annual interest rate of 7.75%. So if we take a look at that, you can see here that you can adjust your margin settings. And if we scroll down, you're going to see the yearly interest rate at 7.75%. So that's what you're going to be charged on any amount of margin that you're using annually. So that means that if you're borrowing money, you want to be making more than that 7.75% if you're going to be using margin so that it makes sense and you're actually making money and not losing money. So what are the risks of trading with margin? One of the biggest risks of margin trading is that you could lose more money than you invested. This is because you're essentially using borrowed money to buy stocks or equities. If the stock price goes down, you'll have to pay back the broker the full amount you borrowed, even if you lost money on the stock. Another risk of margin trading is that you could be margin called. This means that the broker will demand you repay the loan plus interest immediately. So if you can't repay that loan, the broker will actually sell your stocks to cover the debt. And this could result in losing even more money. So you need to be careful and know what you're doing. Now, what are the rewards of margin trading? The main reward of margin trading is that you can potentially make more money than you would if you didn't use margin. This is because you're able to buy more shares of stock or mutual funds with borrowed money. If the stock price goes up, you'll make a profit on the entire amount you invested and not just the amount you put down. So I want to go ahead and reference an article here, and this is from the National Bureau of Economic Research at Cambridge. So if we scroll down here, this is an interesting article to read through, but one of the main points that I want to get to is this paragraph here. So we find that people should be holding much more stock when young. In fact, their allocation should be more than 100% in stocks. In their early working years, people should invest on a leveraged basis in a diversified portfolio of stocks. Over time, they should decrease their leverage and ultimately become unleveraged as they come closer to retirement. The expected gain from this improved asset allocation relative to traditional life cycle investments would lead to 90% higher retirement wealth. This would allow people to retire nearly 6 years earlier or to retire at the same age, around 65, and yet maintain their standard of living through age 112 rather than 85. So in other words, you would have a lot more money upon retirement at that age. Now, another way I like to think of margin trading is this paragraph here. So this leads to our simple advice. Buy stocks using leverage when you're young. One way to have more invested in the market when young is to borrow to buy stocks. This is a typical pattern with real estate where the young investors take out a mortgage and thereby buying a house on margin. We propose that people follow a similar model for equities. So if you think about when you're buying a house, right, you're buying it on a loan. So they're talking about comparing that to using margin when buying equities. It's a neat way to look at it. The rewards can definitely outweigh the risks. So now let's get into some examples of how I plan to use margin in my investment account. If you look at my total portfolio value, you'll see a balance of $54,390.08. But my buying power is $50,673.63, and that's with a decent amount of money invested already. So why is that? It's because I have margin turned on. And specifically, I have about $25,000 as my limit set. So if we click on my buying power here, it'll break it down for you and it'll show you my cash available, which is $25,673.63, and my margin total, which is $25,000, which is where I have my limit set. So my total buying power is now $50,673.63. And guys, you can actually borrow up to your full cash amount in your portfolio. But for my risk tolerance, I think about borrowing half of my portfolio size or a little less is comfortable for me, but you have to do what works for you and your risk tolerance. So what are some good strategies on using margin? Well, I think one of the best strategies that you can do right now with margin is selling put options. And by selling put options, you're essentially agreeing to buy shares of a company at a designated strike price that you can choose. In doing so, you get paid a premium for selling that put option, thus generating passive income. Now, here's where using margin is pretty cool. When you agree to sell a put option, you're required to give a cash collateral of 100 shares of that stock at the price that you choose. So let's say you were to sell a put option on Google for next week. So we'll go into Google, trade options, and we'll look at selling a put here. So you can see at the top, I have sell put selected. So let's say you wanted to sell a put on Google for $122 strike price. So you're agreeing to buy Google at $122 a share if the price of the stock is below $122 at the end of next week. In order to do this, you'd have to have $12,480 in your portfolio, which is the equivalent of 100 shares of the stock. Now, what's pretty cool is if you do this using margin, it doesn't actually count as a purchase. Therefore, you're not technically borrowing the money. So that 7.75% APR isn't really being used here. So we can leverage margin essentially for free to earn some passive premium here. Now, if you hold the option until expiration and end up getting assigned the shares, then you will be required to purchase the stock, and then you'll be charged that 7.75% interest rate while you're holding the stock. However, if you do get assigned the stock, then you can just flip over to selling covered calls on the stock here. And in doing so, you can continue to generate more passive income or premium while you're selling these calls. And in doing so, you're going to earn more than that 7.75%. As we can see, these premiums are pretty good. So if you calculate that out weekly over time, it's going to be a large percentage. So this is how I plan to use margins safely, which is essentially the wheel strategy of selling put and call options. Now, I can't stress enough that this should only be done using safe, reliable stocks that have good, consistent track records of rising over time. I'm talking about S&P caliber companies, Amazon, Google, Meta, Apple, Microsoft, or even index funds like SPGY is a great one, which is a technology sector of the S&P 500. You can use SPY, which is an ETF that follows the S&P 500. So you only want to do this on stocks that are these big companies that you can rely on and that are not going to go anywhere. You don't want to do this on hype stocks that could go up and down, and they're very volatile because you can lose a lot of money and even more money than you have in your account by doing so if you're using margin. So in conclusion, using margin does have its risks, but if you're using it properly, the rewards can outweigh those risks, and it can speed up your trajectory to financial freedom or retirement. If you guys want to see me implement margin in my account and follow along, please don't forget to subscribe so you don't miss any updates from my channel. If you guys like this information, please take a quick second to hit that like button below and comment any questions that you have. Thank you all so much for watching, and we'll see you in the next one.